Gene, let's talk assets. What do we buy? What do we invest in, given the increased global uncertainty that investors are putting their money to work in right now?
Yeah, I mean, I would say on that, our view is that, in spite of the fact that you have strong synchronized global growth, a lack of imbalances, we really don't feel like you want to put too many eggs in any single basket right now. From a bond perspective, we would say that, we don't want to get too bearish on duration. We like core government bonds generally, but certainly wouldn't be over our skis on those. And that really reflects the fact that we feel like the Fed is more mature in its tightening cycle. But at the same time, we recognize the need to protect against inflation risk, and it's actually quite cheap to do so. So we think TIPS look pretty good. Now, when we look around, at spread product, credit product, emerging markets, we've actually find emerging market, local currency, and FX relatively cheaper than other asset classes, particularly credit. We find that there is a lack of imbalances in these economies. The valuations are reasonably attractive, and you generally get compensated for the risk. So in the context of being a little bit more careful everywhere, we probably do have a skew toward emerging markets.
And very briefly, Gene, weakening of the Korean won, for example, and other Asian currencies, is that warranted?
I think it is warranted to the extent that you have geopolitical uncertainty. So I would say that almost everything you need for emerging markets to be performing well, low inflation, gradual Fed, strong, stable activity, are in place. But you've got this geopolitical uncertainty that the market needs to weigh up, and it'll take a bit of time.